Hello, today is Friday. It is 4:46 p.m. after the close on November 18th, 2022. Today's session is titled Stock Market Volatility, Yet Optimistic Signals, and this is your weekend report. Hi, this is Jonathan Gurney, Portfolio Manager at Gurney Financial. Friendly reminder that this post is for informational use only. The views expressed are those of Jonathan Gurney, that's me. The material is not intended to be relied upon as a forecast, research, or investment advice and is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. In short, we're keeping clients aware of what is happening, what we're seeing, and how we're positioned and why. It is a very difficult market. We were down, I believe, 0.23% today. And not today, but this week, 0.23. Given the volatility, it's not bad. We beat the S&P 500. There are opportunities, but you have to be very cautious. We're going to go over some things that I'm seeing under the hood that are not bad at all. Clients that are wanting to know more about the T-bills that we discussed in the email, that will be at the end of this video. Also, please be aware of the Roth amounts that you can contribute in 2023 increases. So pay attention to that email and we'll address that and make any changes that are necessary. So let's get to the charts. 5 minutes chart, 5 minute clock starting now. Here's the performance for the week. As you can see, not a great week, but we managed risk pretty well. This was not an easy week. What we're doing a lot of times is we are getting tests lower, but grinding higher in time. And I'll show you what I mean by that in a bit here. So there are the indexes, not necessarily a great week, but we positioned pretty hard today, actually. We had a decent day today, really positioning for what I think could happen in the near future. I do think there are some magnets that could occur to the upside based on seasonality. One good thing that I'm seeing is we are getting low volume downtrends. So when things are going down, we're not seeing high volume anymore, which is a good thing. Usually when you see sell-offs, you see big volume. We're not seeing that anymore. So that's one good advantage. One thing that I'm really noticing as of late. Sector performance for the week. Energy still up there, but today actually took a tumble. Like if I show you intraday, you can see it was actually the worst performer today. So kind of interesting there. 1 week, you can still see that in general, the conservative areas are kind of hanging in there. We are getting a rotation, however, and that's important to understand. And that goes into the sector's growth versus value. Here is the general chart of value, okay? Value names such as industrials, healthcare, financials, utilities, materials, and staples, okay? So you can see they have been the area that has been trending, but as of late, we're getting a little bit of a rotation. And as I shift to the growth chart, you can see the main area that's doing well as of late is energy. And that's not really a growth area, but I just needed an area to put it. So energy is really what has performed well. And we're starting to see these names kind of start to outperform the S&P 500 a little bit. Not necessarily this week, but in general, since this beginning of November, we're seeing a bit of a rotation under the hood. So if I were to show you, let's do the monthly perspective. 1 month, you can start to see we are getting a little bit of a rotation. Kind of interesting. We'll see if it plays out, but slowly we're adjusting. What I'm also noticing that is a good thing for the market is we are getting rotations under the hood, and one day IWM or the Russell 2000 might be doing quite well while another index takes a break. That's not bad rotations as long as they both don't die together, and that is what is actually happening. So let me go to the chart. So the 10 big boys this week, mixed results. Tesla is getting hammered, basically because of Elon Musk and what's going on with Twitter there. They don't want to see him losing focus on Tesla, and that's kind of what's happening right now. So Tesla's in a definite downtrend. If I showed you the 1 month, it's not pretty for Tesla. Yeah, not pretty for any of these big stocks. Semis are actually doing pretty decent as of late, but it's hit or miss with that one. So here is what I want to focus on, okay? The key level, as stated in the top right, we want to stay above 39.80. That is the key level. We want to get above and stay above. There have been times to the market where, and I'll definitely mark these out, 37.27, right around here, it was messy. It's a choppy area. It makes you want to sell every time it goes below it, but it keeps going above it, tests it, and goes higher. The next level was 38.33. We kept testing that level, and we went higher. The next level is the 39.80 level, where it keeps bouncing back and forth. We actually opened up right at 39.80, rejected hard, and we tumbled, but recovered toward the end of the day. So we'll see how that plays out. I am positioned long. If 39.80 actually holds, it can lead to very good things. And I do think that this could be a magnet, that this 200-day moving average, basically the 40.67 or the 40.80 level, is definitely a level that I'm targeting, as you can see right here. So those are the key levels that I'm really watching. I think it's right to be optimistic because we keep hanging on to key levels. And as you can see, why am I keep saying and harping on 39.80? Here's why. Above there, good things happen. Below there, we test, and we're trying to get above there. So I added today at 39.48, 39.50, and 39.56. So I'm pressing decently here. If we can't get it this time, I will back out and wait for another attempt. But I do think we eventually get through this based on seasonality alone. Today we actually did pretty decent despite the dollar and yields being up. And I might be able to show that too. Yeah, I think I can. So the dollar was up, yields were up. That's very difficult to have this kind of day. Now, what we are seeing under the hood is some historical stuff, the put-call ratio. So I'm going to go to that chart. The put-call ratio was the highest we have seen in like 20 years, okay? So people are freaking out positioning to the short. That I in my career since trading have not seen a 1.41 put call ratio, meaning the majority are short. That's the huge indicator of saying people are freaking out. And usually once the freak out happens, it squeezes higher. Okay, so it doesn't mean it's going to save you every time, but we're starting to see some decent things. Okay, new lows, new highs versus new lows on the total market is improving. See the green here popping out here. We're starting to see more allocation in active investment managers. It's going to take some time. Don't get me wrong. This 39.80 level is not going to be fun. Next perspective. Okay, we went over that. This is the more long-term perspective that I really want to focus on. See this giant cup? If I'm being honest, I think that's going to happen. It's very symmetrical. It's not going to be fun. As I stated, we're right here, 39, like 60, 65-ish. It's not going to be fun. It's going to try to kick everyone out right before it makes a move. If we lose 39.05, as stated to the top right, I think we have problems, and I will be out. But right now, I think it is right to remain optimistic for a lot of reasons. Okay, so let's go to the next chart. Something that is very important that I keep harping on: do not bring politics into the stock market. Now, because of this, gridlock in the stock from a political standpoint in the midterm actually leads to very good things. You're like, Jonathan, I'm confused. And I actually had to explain this to somebody. Jonathan, 2021, or 2022 is a terrible year. It's not actually in here yet because the year hasn't finished. So 2021 was a good year. Basically, 5 names really held up the market very well, while many names were in a recession already. In fact, like the ARC names, which unfortunately we were in, were down like 26% that year. So we were fortunate to even come out even last year. So it was not a fun year last year for me. Just being realistic about that. But good things can happen. The average gain when things don't change much in the house is good things ahead. Okay. So remain optimistic. Doesn't mean it's going to happen. I'm going to trade price regardless. But there are some definite things that I like that I'm seeing. Another one, credit the last chart to Ryan Dietrich. This one, Charlie. The 30-year U.S. mortgage rate moved 7.08% to 6.61% over the last week. That is a huge move. That is the biggest move since November of 1981, meaning rates are actually coming down a little bit. Doesn't mean it's going to stay there, but that lower rates generally are good or better for the growth stocks. And that, in my opinion, is usually what drives the market. So if you are optimistic on the market, you want to see the big 10, these names, do well. You want to see these names wherever the heck they are. If I can find them. There we are. So you can see here, if I go to the week, still very mixed results. Okay. Very mixed results. So overall, we're seeing some good things. I'm optimistic at this point because every key level that we struggle at, which this one that we're really dealing with here is the 3980, it's not going to be fun to get through it at all. And if I show you in this perspective, this is what I'm looking at. And usually it takes some time. See how it's trying to turn here? It's not a fun road when this happens. It's going to try to kick you out 9 times out of 10. Okay, I don't think this is going to be an easy turn, but I think it's right to remain optimistic at this time based on the price action that I'm seeing. That could change Monday and I could be completely out. So right now, I think we are seeing a big cup that could lead to very good things by the end of the year, even in a terrible environment. I'm not naive to the fact that things are very, very bad. I very much see that, but that does not mean the market is just going to die. Okay. So one more thing that I want to point out is this. I wanted to show you the growth stocks and show you that on these pullbacks, which it basically closed flat, but the majority of the day was red. And we're not getting a lot of volume, which is a very, very good thing. So what you don't want to see is a big down move and the volume be huge. That means people just don't trust it. But we're really not seeing that. The last big down days, we're not seeing big volume here, which is very interesting and something to pay attention to. It doesn't mean we're just going to explode higher here. It doesn't work that way. But remain optimistic. Finally, we talked about the put call ratio. We talked about the gridlock in the market. We talked about risk reward. I think it's not going to be fun this next week, but usually a Thanksgiving week is actually, I believe a stat that I saw, Thanksgiving week is about 80% of the time up about 0.65%. So those are pretty good odds. It doesn't mean it's going to happen. Again, I'm going to trade price, but overall, there are some things to be optimistic about here. The market will turn before the economy does. You got to keep remembering that. So I'm trying to remain optimistic based on what I'm seeing in price action, not based on what I'm seeing everywhere else in the news. Everybody, you have to start with a bias, but if we lose 39.31, we could be in for a direct test at 39.05 quick. Okay? And that's not a small move. Something to pay attention to. So I will definitely be paying very, very close attention as always. So finally, the thing that I wanted to talk about is T-bills, okay? The big question is, does it make sense? And this is what I want to show, okay? Now, if you are in your 20s to 35s to 40s, this is not applicable to you. The only way it's applicable, in my opinion, is if you're the person that is older, that has a ton of money, that hasn't followed the plan and basically you have too much in your checking and savings account. Again, generally my clients only want to have 3 months of expenses in their checking account max, because in the joint account or trust account, we can use those monies. Okay, so these are talking about new monies in general. Or if you have a big, like you're purchasing a house in the next year, I want to point this out to you. I'm not pushing T-bonds or T-bills whatsoever. In fact, I think you're going to miss out on a rally. But if you're saying, I can't lose this money, or I'm freaking out with the market and I would rather be making, 2 or 4.6% on a 6-month. So these are treasuries, treasury bills, so they will grow tax-free. And you're like, Jonathan, why don't you just put my money in there? Because I'm afraid the market's actually going to do very well and outpace this in 6 months. However, if you're buying a house sometime soon, or if you're just in this situation, I am not following discipline, I have way too much cash sitting in my checking and savings, a 4.62% guarantee over 6 months is not bad. It's tax-free growth, okay? So that's what I want to point out is I'm not pushing this whatsoever. In fact, I will be doing none of this. But for the person that is maybe older or has a goal in mind that is afraid to put it in the market short term, you could consider a 3-month 4.29 not bad. Growth, tax-free. 6 months is 4.6. Once we start getting into here, I don't think the risk reward is really that great between, 4.6 and a 1 year 4.7. I would rather do a couple of these and spread them out. I don't want my clients to be locked in with dollars when the market is this low. Okay, I don't want my clients with current existing dollars to be freaking out about that. In fact, I think you would be timing a bottom in buying these with current dollars. I want to get the rally with your current dollars invested, but new monies that you might need in the near future and you can't take a loss on. If you're like, I have 6 months before I need a down payment or a new car or some type of event, here's not a bad option. Okay, so I hope that makes sense. Thank you for your trust. These are not easy times for anybody. We're hanging in there, but by a thread. I mean, we're getting at times 3 to 6% swings a day. And that's a lot of money. And I take it very serious and it's not fun. But we'll get through this. You have to be optimistic through this. If we lose the key level, you know me by now, I'm out. Whether right or wrong, or whether we squeeze higher, 2 minutes later, I'm out. Okay, so thank you guys. I know this is a longer message, but keep me posted. And also keep me posted on whether you want to increase your monthly contributions, because Roth contributions and IRA contributions increase in 2023. Okay, you see that in your email. You see those details. I'm out of here. Sorry it took so long, but a very important message. Thanks, guys.